What's poppin', investors? I've been waiting for a while to do this one. I'm very excited. I'm going to talk about realty income. Okay, I'm going to share with you, first of all, a little bit of an analysis. I'll do a quick overview of the company. And then the main thing, I want to talk about why the debt is not as big of a problem as everybody else makes it out to be. Okay, after this $5,000 transition. Boom, 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 boom. All right, welcome. Okay, quick overview of realty income. It's a REIT. Okay, I'm going to use stockanalysis.com to figure out just a few numbers. This is not a regular stock, so this website that I usually use is not really going to tell us that much information. But I do want to point out a few things. Number one, you can see on the 5-year trend that the price has been as high as $80. And in most recently, in August 8, 2022, it's been $75 almost. Now it's trading at $50. That's a huge discount. So investors are throwing the stock out the window, not realizing what an opportunity they're missing, in my personal opinion. So quickly to the financials to glean just a little bit of information here that's relevant to my quick analysis. We're going to go to quarterly and just looking at the revenue. So all the graphs in realty income are just going to basically look the same. They're going to look like this. Slowly up and to the right, and then a big boost in 2021, and then up and to the right again. So the reason is because the realty income's management was shrewd enough to take on a lot of debt and sell some shares when it was prudent to do so, okay, and just stack up properties. That's a brilliant move in retrospect. Obviously now the stock is low, rates are high, so this process should be slowing down, but they keep buying, and I'm not worried about it, especially when they're buying with debt. You'll see why. First of all, let's compare that to shares outstanding. You can see that big bump in shares. Lots of shares were sold at first and second quarter of 2022, the end of 2021, beginning of 2022. Let's see what the price was doing at that moment. So the price was fairly high at that moment. Okay, so late 2021, beginning of 2022, the price was hovering somewhere between, $65 to $72 per share. So I would say that those are good issuance right there. I think they've got a very good deal on it, especially compared to now. They're on the hook they got a lot more capital than they're on the hook for. So there's a lot of magic that goes into what realty income does with their income. One of the things, and the core principle basically, is this built-in annualized 1% increase of rent to all the tenants. It seems very negligible, but that's where all the magic works. Before I go into their quarterly report and look at some very important numbers, let's find out just a little bit about the company, because I have to say it on every video because, it's like they're proud of, right? Advertisement. So basically it's a REIT. It pays monthly. It's nicknamed the monthly dividend company. I really like that aspect, actually. And it has 13,100 real estate properties, declared 639 consecutive common stock monthly dividends through its 54-year operating history. It increased dividend 122 times without a cut. Okay, so that's kind of like the back of the card, pitch. All right, so this company has very storied history. I found this website recently. Somebody linked it on StockTwits. It's called allreits.com. And it gives a pretty nice overview of the valuations from a REIT's perspective, because the numbers don't really make sense too much if you look at it like a regular stock. So it gives you some numbers over here. Like, for example, one important number is right here in the beginning. Next to the price is the price to AFFO. So AFFO means adjusted funds from operation, is 12.6 right now. And the average for the company for the last 5 years has been 17. And average for the sector has been 12.3. Usually this stock trades at a premium. So this is kind of but I think it's I think it's an extreme steal. Okay. So I've been racking up this company, been selling puts, and I have been acquiring lots of shares. I'm going to have 2,000 shares pretty soon of this company. And many of them, are on margin because I ran out of dry powder trying to buy as the share was sliding down somewhere around the 58 to 56, 55 range. Now it's at 50, so I'm going on margin just to buy this company because I think it's a great steal. Dividends, this shows you a nice graph over here of the dividend history. You can see the gradual increases. What did they do in 2008 when every REIT in the universe was cutting dividends? They raised dividends very slowly, very softly. Didn't really make any big moves from 2007 to 2012, but then started to notch up the increases when confidence built. In 2013, it was a huge dividend increase right there. And they've been keeping up, and now the trajectory is in place. There's a little bit of brief dividend history. Dividend growth is about 5.2% per annum. So, it's a little bit weird because the 3-year CAGR is 3.8, the 5-year is 3.6. A little bit of acceleration. The last year has not been that good though, so just keep that in mind. I'll try to go into why in a little bit. Payout ratio is 79%. The sector is 75.9. 5-year average 78.3. Nothing to worry about there, really. Then it has a comparison to the 10-year bond, which is yielding 4.58 at the moment. O is yielding 6.25, with the 5-year average being 4.65%. So again, a steal at these levels. Here's where the slowdown is evident. AFFO. 1 year increase of 6.7. Now these numbers really don't mean anything because Realty Income tends to issue a lot of shares, so we really got to look at it on a per share basis, which is the next graph here. You can see the 3-year CAGR is 5.3, 5 years 4.5, so quite a bit of an increase here in the last 3 years, except this year. It's only up 0.08, which is fine. We'll talk about it. It's okay. Debt to assets totally acceptable at 36.2, and I actually think they should be taking in more debt. Forget about selling shares right now. Issue debt. It's fine. I know the rates are higher, but I'll show you why in a little bit. So they've been increasing the footage, increasing the size of the company is actually very important, especially versus net issuance because of shares. Because the greater the size of the company, that 1% increase is going to really start hitting super hard when you're talking about, you have, millions of square feet of properties versus like one building, right? 1% is just a lot of money. And if the share issuance is not as dilutive, then it works out to a very, very, big advantage for the company. So size does matter. Largest tenant, Dollar General, that's a little bit of a problem. Many of the dollar stores have been struggling lately. And, the movie theaters and all that. So it's a bit of a problem. But the thing is that buildings are still going to be there. Somebody else is going to move in. Yes, will there be a dead period of like a few months? Perhaps. But the occupancy rate is at 99. The company can afford a 97, occupancy rate. It's not going to be that big of a deal. These buildings are freestanding, buildings. They're not like in a mall or anything like that or some weird areas. Like they're freestanding buildings and they're going to get occupied. Someone's going to take them. I promise. It's fine. It's fine. They're not going to run into tenant risk. All right. It's good. So lastly, what I want to talk about is on the quarterly report here. I think you can see. If you're on the computer, you can probably see this. I'm going to upload this in HD, so you should be able to see it. But this is basically their debt. This is what people are worried about. This is why the stock is mainly tanking, the share issuance and the debt. But the thing is, the debt is not an issue. First of all, it's not an issue because they only have, look at this, about $3 billion of debt yielding above 4%. You guys see this right here? That's not that much. And the thing is, they're due, 24 and 2025. It's not that big a deal. Most of their debt, look at this debt, by the way, on 2027. It's only at 2.66%. That's so low. That is so low. Okay, ridiculously low. And then thereafter is 3.5% on their fixed rate. Okay, and most of their debt is fixed rate. Look at this, fixed rate debt, 15 billion. The variable rate debt is only 2.5 billion, and it's mainly due on the 2026. Okay, right now the rate they're paying on that is 5%. It could go higher if rates spike, but that's pretty low. I mean, it's basically at bank issuance rate. Like, this is not a big deal. 2.5 billion variable rate, and we're talking 2026. So it's not going to become a problem for a while. So debt, not a problem from that perspective. Okay. Another look here at their FFO. One sec. Scrolling up. Where is it? It was here. Okay, there we go. FFO. Actually, let's look at FFO and normalized FFO. So we want to look at per share figures because of the dilutive nature of the company. And it looks like, they're increasing. 3 months ended 1%, 6 months ended 1.5%. Okay, and normalized FFO per share is growing at 1%, which is totally fine. We want to be above 1%. Basically, that's the goal there. Because if it's less than 1%, that means you're growing at less than the rent increase on all your tenants, and that's not preferable. So here is why the debt is not a problem, and why I think all the worries in the market are misplaced. All right. Let's say a debt is issued. Okay, let's try to make it simple. Let's say they borrow $100 and they buy a building with that, right? It's worth $100. Now they have to pay interest on that $100. Let's say it's about, $1. Okay. How about $10 per year? And the rent is coming in at $10 per year. So basically, they're not accretive, right? We're not gaining anything from this transaction. We got to pay interest on the $100 or $1, and then we got to pay, and then we're taking in rent of the same amount. And so it's kind of like a no win, no lose, right? But once you add that 1%, not only are you winning the following year because the rate on the debt is fixed, and the rent that you're receiving is ever increasing by 1% per year. And it's not just 1% per year, it's stacks, right? It's 1% of a bigger number. Yes, it's not that much bigger of a number, but it's still 1% of a bigger number. So over the span of, like, let's say 30 years, that thing grows exponentially, albeit very slowly. It's growing at, 1.01% exponentially, and the debt is fixed. So even if you are taking in a higher interest rate, a higher fixed interest rate over, let's say 10 or 20 or 30 years, then the rent that you're receiving, it can end up still being in your benefit in the long run. Okay. And this company is definitely in growth mode right now, and they're kind of making up for that by aggressively issuing shares and taking on debt to buy new properties that they think are a good deal. Another thing I like about this company, so this is why basically there's no problem with the debt here. Okay, over time it just works itself out, and it's not like they're over debted. I mean, some REITs are running at like 100% debt ratio, right? This is only 35%. It's not drowning in debt. It's not having trouble paying their debt payments. With time, things work out in Realty Income's favor. Another point that I wanted to make is that I trust their management, okay? Because first of all, they've done really well so far. And second of all, they have strict requirements when they're purchasing properties. They're not just purchasing any properties. They have properties that, again, that are freestanding, right? So they're not being dragged down by the dynamics of, let's say, an entire mall or something like that. And also, they like to rent properties to businesses that are fairly recession proof. Now I got to talk about the big, elephant in the room, which is the recent purchase with shares, mainly, of Wynn Resorts, Bellagio. The Bellagio. Let me tell you about the Bellagio, okay? First of all, yes, some people, it might be like kind of an expensive deal. I don't know all the ins and outs, to be frank. I don't know the extreme details of the exact funding and financing and whatever the deal was. And I don't know how much they're paying per rent. But I got to tell you something about the Bellagio, right? I went to the Bellagio a couple years ago, and I told them, look, I need a room. And they're like, oh, we have like one room left. It's going to be $950 for the night. $950 for the night, guys. And they only had one room left for the day. Okay, one room left. So, I mean, the other rooms are probably occupied at like $500 plus. That building, first of all, it has cachet, it has prestige, it has a good casino. It's a great building. It's right in the heart of Las Vegas. I mean, it doesn't get better than the Bellagio. So you want to pay a little bit of premium for quality. Like, I do not believe that Bellagio is likely been bought at a price that's too high. It's kind of like, I look at it a bit like a soccer team. Like, everything that has cachet like that, it's kind of like buying a soccer team where, like, yeah, even if it doesn't earn, which it does earn, but even if it doesn't, the value of the property just goes up. Okay, like the soccer team, is going to go up. Forget soccer, any sports team. Okay, we're in the States. Let's talk about football teams. When do you know when? Can you recall a time where a football team has been sold at a price less than it's been bought, given the span of like a couple years at least? Those kind of things don't happen, right? I don't care how big a recession is, the price always goes up of these franchises. Okay, so I think Bellagio is got a name. It's a bit of a franchise. Okay, and not only that, but it commands a lot of money for its rooms. I mean, it turns over many thousands per day. Okay, not just the casino, but all the rooms packed at $500 plus. You can get a room on the same street, okay, same size building, same street, different brand name, for like $250 instead of $500. So that's like that's an extra 100% profit margin right there. Okay, than everybody else. Okay, let's not talk about profit margin. How about operating margin? Okay, or something, I don't know. Net margin, but it's quite a bit higher than any other hotel on the strip. So that's kind of like the Apple of resorts. So it's okay to pay a little bit of premium. It's okay. One thing I do disagree with, though, is the share issuance, because that increase in the dividend is going to bite them in the back, right? When you issue shares, it's kind of like issuing debt, but with that 1% increase built in, or whatever the dividend is increasing per year, 5.2% built into it every year. So I would not be so hot, selling their shares, because it might come back to bite them in the end, because the dividend keeps increasing every year. So their interest, basically, you can treat it kind of like an interest expense. The interest expense on selling shares is ever increasing. So, I know they like to be aggressive, and that's fine. But they just have to make sure, unlike the last year, they have to make sure that they continue back on the olden days where, the share issuance has to be accretive. But the thing is, at these prices, it's unbelievable. I mean, I cannot believe, okay? I cannot believe what I'm looking at. Look at this price chart. Look at this price chart right here. 52-week high, 68.85. 52-week low, 49.38. We're sitting at $50 right now per share. $50 for the highest quality REIT in the entire world. Okay? I'm dubbing it right now. There's maybe like 2 or 3 on their level. Okay? And they probably don't pay as high of a dividend at the moment. It looks like this website's spinning it at 6.25%. Maybe that's for next year. $3.12. So Anyways, I'm very excited. If you think I'm full of it, or you think that I've got something wrong, I'm more than willing to learn. I'm just an investor, just like you. I'm not a CPA or whatever, and this is not financial advice, okay? I'm not some guru. I'm just an investor. I'm just hoarding shares. If you think that I've got something wrong, I want to hear about it because I want to learn. I'm here to learn. So please put a comment down below and tell me what I got wrong. Or if you're on board with me, just let me know as well. Like, tell me how many shares you're buying. I told you I got 1,700 and another 300 coming in at $55 per share through put options. So yeah, let me know. Excited. Peace out.